immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 13.1 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and then you're told 𝐿𝐿 Limited has a cost of capital of 10%. In the other paragraph, you're told on 1st of October 2024, 𝐿𝐿 Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of 𝐶𝐶𝑠 for an immediate cash payment of 1,500 million. The following financial statement relate to group of companies, or yes, to group of companies. So you have the statement of profit or loss for the year which ended 31st of March 2025 for 3 companies, 𝐿𝐿, Paper, and 𝐶𝐶𝑠. Then down there we have the statement of financial position for 𝐿𝐿, Paper, and 𝐶𝐶𝑠. And then down there we have additional information number 1 all the way to note number 5. What are we required to do here? We're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025. And part B, we are required to prepare the statement of financial position as at the same date. Do you have the question with you? If yes, please confirm. Please confirm. I can see we have 1 hour 20 minutes. We must finish this particular question here. We must finish that question. Okay. So what are we told? What are we told? That is the question number 2. So the question is, 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in Paper Limited, another public limited entity, on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 13.1 million deferred until 1st of April 2026. This is what we refer to as the deferred consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐿𝐿 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐿𝐿 Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of 𝐶𝐶𝑠 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for 3 companies, 𝐿𝐿, Paper, and 𝐶𝐶𝑠. We have the statement of financial position for the 3 companies, that is 𝐿𝐿, Paper, and 𝐶𝐶𝑠. And then we have some additional information. This was actually one of the simplest questions which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? Part A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. That's the first thing you always need to have in any question for group accounts, the group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called Paper, a public limited company, on 1st April 2024. So the company which is called 𝐿𝐿 Limited, this company acquired 80% equity shareholding in a company which is called Paper Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐿 is the parent, and then paper is the subsidiary. You can see also we're given the date of acquisition. Then from there, once we go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐿 Limited, our parent company, with another entity entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of what? Of 𝐶𝐶𝑠 for an immediate cash payment of 15. So this company here, we are told acquired 50% shareholding in a company which is called 𝐶𝐶𝑠 Limited. 𝐶𝐶𝑠 Limited on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of a financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement, because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it with present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐿𝐿 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary, Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of 𝐶𝐶𝑠. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually we said once the subsidiary company revalued the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which we are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as a fair value adjustment, and this is by Paper Limited. By Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment, and basically this is the adjustment in relation to the revaluation gain or loss. But remember, you said in most of the questions for group account, you will come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset approximated the carrying amount with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, Then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by paper. Did the paper limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number two, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. Depreciation other charge. And equally this depreciation other charge will be by paper, is by paper limited. So you need to recall the formula. There is a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have, from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what year? We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful life. And I hope you can see that within note 1. Can you see the remaining useful life? How many years? In note 1, remaining useful life. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful life of that asset, can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here, we had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation other charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation other charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation other charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation other charge to what? To the administrative expenses. to the administrative expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand, because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation other charge. Let's move to point number 2, where we are told 𝐎𝐿 Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained, that if you come across that information, that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCI fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to Rock Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to Rock, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by Paper to Rock, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiaries are fixed sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by Rock Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we compute the amount of unreleased profit, So unrealized profit on inventory. Remember, unrealized profit, we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Lock, but basically some of the goods remained in the inventory of Lock. They were not yet sold to third parties. We need to compute the unrealized profit, and this unrealized profit is always by the selling company. The selling company is this one. So this is unrealized profit by Paper. So how do we compute this unrealized profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit basically by applying this formula here. We will take the unsold goods, and in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Rock. The unsold goods will be half of the goods which were sold by Paper to Rock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction. As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1 over 5. So this one will be, the margin will be 1 over 5. So how much will be our unreleased profit here? So it will be half to 50, and basically that will be 50 million. So this unreleased profit number 1, this will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number 2, this one will also be deducted from the retained earnings of the selling company. The selling company is paper. That one will be deducted from the retained earnings of paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. To the group cost of sales. Those are the 3 adjustments which will be made as far as that and this profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, that point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here would be 500,000. 500 million, that is, because the amount of money which Lock Limited was supposed to pay paper was 500 million. So this amount is the one which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically reveals that both goodwill on acquisition and on paper limited and the interest in Caesar were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis, or something you need to apportion, you apportion it on time basis. You apportion it on time what? Basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition, because there is something we will compute there. Then first of all, we compute the goodwill on acquisition of this company here. Remember, I said we only compute the goodwill on acquisition of the subsidiary, and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company, that is paper, paper limited, as And as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have 2 columns, and our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in 2 forms. The cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, under the non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 31 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and 𝐿𝐿 limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331, and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition, 1st of April 2024? This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end first, or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1, remember the formula here, 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay. So then this is basically the purchase consideration paid by the parent. And then now to this, what we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one? Acquired. And basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. plus pre-acquisition reserve. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if you're given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically, what we know is that that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically, what we know, I've said that the retained earnings which are given there of 1,800, this is the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings of this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there a revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI, parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, 2023. Question 1B. Question 1B. Are you there? Zephyr. Sadrach, are you there? Aaron, are you there? Reese, are you there? Is Elizabeth Betty here? Reese, are you here? Emma, you are there? You are there? Okay. Natalia, are you there? Okay. Sawa. So basically, what are we told here? What are we told as far as that question says concerned? What are we told? So the question reads, basically a small one. It reads, Godoro Limited supplies high quality mattresses. The company outsourced these mattresses from a supplier in town, and then you're told Godoro Limited estimate that the total inventory holding cost, the total inventory holding cost of one mattress per annum is as follows. So basically what you're given here is the holding cost. So we are given the various components of the holding cost, which comprises of the opportunity cost, the obsolescence cost, the storage charges, the handling cost, and the insurance. And basically you're given those particular costs as a percentage of the purchase price per unit. And basically you can see we are given the total holding cost as 15% of the purchase price per unit. And then number one, we have some additional information. Number one, you're told the annual sales demand of the mattresses is 480 mattresses. Number two, you're told each mattress costs shillings 4,000 to purchase from the supplier. Number three, we are told the ordering cost is 62.50 per order. And then finally, you're told the suppliers offer a 3% discount for orders of 120 mattresses and a discount of 5% for orders of 180 mattresses. So what are we required to do here? In Roman 1, we are required to compute the economic order quantity of the mattresses. In Roman 2, we are required to determine the cost minimizing order size from the supplier. We are going to start with Roman 1, and then I will be able to explain how we do Roman 2. So in Roman 1, we are required to compute the economic order quantity of the mattresses, the economic order quantity of what? Of the mattresses, economic order mattresses. So automatically, the first thing we need to recall here is how do we compute the EOQ? To compute the EOQ, the economic order quantity, we take the square root of 2DC naught, that is 2, multiplied by the annual demand, multiplied that with the ordering cost per order, and basically divided that with the HC. HC is the holding cost or the carrying cost per what? Per unit. Now, do we have these values here? Do we have these particular values here? Yes. So if you go back to the question, I think the additional information, and remember in our case, we are told that this company basically deals or basically sells mattresses. So if you go to note number 1, in note number 1, you're told the annual sales demand of the mattresses is 480 mattresses. So basically it means that this company here basically do what? It purchases some mattresses, and then it sells those mattresses. So we are told the annual sales demand is 480. So basically what our company here need to purchase in order to sell will be 480 mattresses. So these are the mattresses which are purchased by our company. So that is basically the annual demand. Do we have the ordering cost per order? Yes, the ordering cost per order, basically this one is given in note number 3. Additional information number 3, we are told the ordering cost is shillings 62.50 per word per order. So that is basically the ordering cost per order. What about this one? HC, the holding or the carrying cost per mattress. So that one is basically given below paragraph 1. And you're given the holding cost of mattresses per annum, and basically you're given that is a percentage. So you can see we're given various components of this holding cost, but basically what we consider here is the total percentage. The total percentage, which is below paragraph 1, 15%. And basically, if you check up there, you'll be able to see that percentage, or this is a percentage of the purchase price. So to compute this one, we take 15% of the purchase price per mattress. So what is the cost, or what is the purchase price per mattress? Can you be able to see the purchase price per mattress? This company purchases each mattress at an amount of how much? Can you see that in the additional information? Yes, I'm told by Naitare. In additional information number 2, each mattress costs shillings 4,000. Cost shillings what? 4,000. So therefore, that is the purchase price. So this one is always computed as a percentage of the purchase price. The purchase price is what? Is 4,000. So this will give us what? Will it give us 600? Is it 600? 600? Is that what you're getting, Emma? Aaron, are you getting that? Abdinasil, are you getting 600? Yes. So in our case, therefore, we can move and basically we compute the economic order quantity. So by taking 2 times the annual demand, which is basically 480, times the ordering cost, which is basically 62.50, divided by holding cost, which is basically what? 600. Which is what? 600. So let's get the final answer here. We get the final answer. We get the final answer here. So what will be the final answer? So we have 2 times 480 times 6250 divided by what? 600. And basically that is giving us 10,000. So that means that the economic order quantity here are 100 mattresses. Are 100 what? Mattresses. 100 what? Mattresses. So what does that mean? What does this mean? That the economic order quantity is 100 mattresses. It basically means that for this company to be able to minimize the costs associated with the inventory, the holding cost, the purchase cost, and also the holding cost, the company, anytime the company is placing an order, our company should order how many mattresses? 100 mattresses. That is the economic order quantity. It is the order quantity which will minimize the company's what? The company's inventory, the company's cost associated with what? With this particular mattresses here, or basically associated with the purchasing this particular mattresses. Now that basically what is required in Roman 1, and basically by doing that, the marks are located there were 1, 2. Then I want us to move to Roman 2, and basically what are we told? We are required to compute the cost minimizing order size from the supplier. The cost minimizing order size, order what? Size from who? From the supplier. From who? From the supplier. So in other terms, what you are required to compute here is the order size, which by the end of the day will do what? Will minimize, that is the company's what? The company's cost associated with what? Associated with the inventory. Now, which order size do we have? Now, in this case, if you go back to the information which are given in note number 4, can you go to note number 4? Because that is what you're going to use here, plus what you have computed up there. We are told the supplier offers 3% discount for orders of 120 mattress. Now, remember what we have said in Roman 1. For this company to be able to minimize the cost associated with the basically ordering and also holding these particular mattresses, the company has to order how many mattresses? 100 mattresses. Through that, the company will be able to minimize the total cost associated with this particular inventory of mattresses. But the supplier here has extended a discount to this company, and the company is told that if the company orders 120 mattresses instead of 100, the company will get a 3% discount. Automatically, what that means is that, remember, the purchase price per mattress is 4,000. So if the company purchases from 120 mattresses, the company will not pay 4,000, but the company will do what? Will be given a 3% discount. The price now to be paid will be 97% of this. So then in the same point you're told, and a discount of 5% for orders of 180 mattresses. For orders of 180 good mattresses. So therefore, in this case, our company has 3 options. Our company has 3 options. Number 1, either to order 100 mattresses, which is basically the company's computed economic order quantity, or the company to order 120 mattresses and basically qualify for 30% discount, or the company orders 180 mattresses and the company qualify for 5% discount. Now, the company has those 3 options. Now, what we are required to do here is basically we determine the order size, either 100, 120, or basically 180, which basically will result to the least cost. To the least what? Cost. Basically, what in other terms we need to do is to evaluate those 3 orders. How do we evaluate the orders? Usually in management accounting, we evaluate the options in terms of the cost. In terms of what? The cost. Because the company here has 3 options. Either to order 100, to order 120, or to order what? 180. Which cost do we need to compute here of each order size? We need to compute the total cost, which will comprise of the 3 costs: the purchase cost, the ordering cost, and also what? And also the holding cost. So therefore, but before we do that, we need to list those options available to this company. So we have said our company has got 3 options: either to order 100 mattresses, or the company can order 120 mattresses, or the company can order what? The company can order 180 mattresses. 180 what? Mattresses. Now, if the company orders 100 mattresses, what will be the purchase price? The purchase price, in fact, we can just write it up there. Purchase price, which is denoted by small p, that one will be 4,000 per mattress if the company order 100. And then we also know what is the holding cost. The holding cost here will be 15% of 4,000, and basically that will be what? Will be 600. But now, if the company orders 120 mattresses, the company qualifies for a 30% discount. What will be the purchase price here? The purchase price will not be 4,000, but our company getting a 30% discount. So the purchase price here will be 97% of 4,000. So this will give us a purchase price of how much? A purchase price of how much? So the company will get a 30% discount. So instead of paying 4,000 for each mattress, the company will pay 97% of that. That will give us how much? Yes, I'm told by Jeff that this will give us 38.80. So that will be the purchase price per mattress. And then that also means that we will have a different holding cost, because holding cost, this one is always computed as a percentage of this. So the holding cost here will be equal to 15% of 38.80. 38.80. So let's compute this one. The new holding cost. The new holding cost, I'm told this one by Nigeria will be 582. 582. 582. 582. 582. So we do the same for the other order size, which is basically the company ordering 180 mattresses. So here the company will get a 5% discount. 5% discount. So mean that the purchase price here will be 95% of 4,000. Or 4,000. So how much will be the purchase price? Yes. How much will be the purchase price? How much will be the purchase price? How much will be the purchase price? Yes. The purchase price here will be 38, and then the holding cost here will be 15% of this. 15% of that. So what will be 15% of that? It will be what? It will be 5 what? It will be 570. It will be 5 what? It will be 570. It will be 5 what? 70. Now, having this information, what I want us to do, I want us to evaluate these three options. And basically, I've said we evaluate these three options, in terms of computing the total cost of each option. How do we compute the total cost? The total cost, this one is equal to the purchase cost. The purchase cost is equal to annual demand times the purchase price per unit, which is basically small p. This is a multiplication sign. Then to this, we add the holding cost. The holding cost. How do we compute the holding cost? The holding cost is equal to Q. And basically, in this case, when we talk about Q, remember, is the order quantity. Because, like in this case here, our Q will be 180. Here, our Q will be what? 120. Here, our Q will be 100. Q is basically the order quantity. So we multiply that with HC. And then to this, we add what? The ordering cost. So the ordering cost will be equal to annual demand divided by Q times what? Times C naught. Times C what? C naught. This is basically how we compute the total cost of each option here. Of each what? Option. So what I want us to do, I want us now we compute the total cost associated with each what? With each order size. Associated with each order size. So let's start with this order size, where our Q will be 100 mattresses. 100 mattresses. 100 mattresses. So we need to compute the total cost. So what you just need to note is what will be changing, but our formula is also very, very important. We start by computing the purchase cost here. So the annual demand, this one will not change in all options. So what will change is the purchase price. For example, here the purchase price is 4,000. Here is 38.80. Here is 3800. The purchase price will have to change. The other item which will have to change for the different options is the holding cost. This one. But now this one, nothing here is nothing, or basically what will change here is just the Q. It's just the Q here. Yes, where our Q is 100. So we take the purchase price, we take the annual demand. Remember, the annual demand will not change. Were these for 80 mattresses? The annual demand? Yes, the annual demand in note number 1 is for 80 mattresses. We multiply that with the purchase price per unit, which is this one, which is 4,000. 4,000. So that is the purchase cost. plus now the holding cost, which is equal to Q. Our Q here is 100 divided by 2. And then to this we add what? To this we add, okay, we multiply that with this one, with the holding costs per unit. And then to this we add the ordering cost. The ordering cost is equal to annual demand, which is 480. Remember that is our annual demand. Divided that with the Q. Our Q is 100. We multiply that with what? The ordering cost. The ordering cost is one will not change. It remains as given in note number 3. 62 what? 62.50. So we need to get the total cost. But you also need to note that this 100, this remember is our economic order quantity. And basically we say that at economic order quantity, I think I demonstrated this using a graph. I said at the economic order quantity, so basically these two costs are always the same. The holding cost and the ordering cost are the same. The holding cost and the ordering cost are the same at the economic order quantity. So these two costs, this and this should be the same. I don't know whether you're getting the same value. So this and this one should be the same. Are you getting the same value? 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 Yes, I'm told it's 30,000 each. At economic order quantity, those two costs are the same. Okay, so having that, we need to evaluate the other option, which is basically ordering 120 mattresses. 120 mattresses. So, and we do the same. We compute the total cost, which will be equal to the purchase cost, which is basically equal to the annual demand. This will not change, times the purchase price per unit, which is now 3880, and then plus the holding cost, which is equal to Q. Our Q here is 120. Divided by 2 times what? The holding cost. The holding cost is 582 plus the ordering cost. Ordering cost is equal to annual demand for 80 divided by Q, which is 120 times what? The ordering cost per order, which is 62 what? 62.50. But now in this case, you'll be able to see 120 mattresses is not our EOQ. So therefore, these two costs will not be the same. So these costs are always the same at the EOQ. At EOQ. 120 is not our EOQ. So the two costs will not be the same. So get for me the final value here. Get for me the final value here. The final value here. The final value, what are you getting? The final value, what are you getting? What are you getting? 19 what? Yes, I'm also getting 19, 22, 320. Yes, so that is the figure I'm getting from Emma. Are you getting the same? Aaron? Jeff, are you getting the same? Sadrach, are you getting the same? Are you getting the same values here? DP, are you getting the same value? Please try to hurry up. I want us to do more questions on this. Yes, so that is confirmed. So let's evaluate the last option, whereby the company has been given a discount if it's order 120 mattresses. So we need to get the cost of this order size. So the cost will be equal to the purchase price, or the purchase cost, which is equal to annual demand, which remains the same, times the purchase price per unit, which is this one, 38, plus the holding cost, which is equal to Q. Our Q here is 180, divided by 2, times the holding cost, which is 570, plus the ordering cost, which is basically equal to the annual demand for 80, divided by Q. Our Q is 180, times ordering cost per order, which remain the same, the same. So let's get the total cost associated with that order size. So the purchase price or the purchase cost will be for 80 times 3,800. That will be 1824. Then we have 180 divided by 2 times 570, which is basically 51,300. And then we have 480 divided by 180 times 6250. 6250. Yes, what are you getting? What are you getting? You're getting what? Yes, 91, 967. 967, is that what you're getting? Is that what you're getting? 1891, yes. So basically, in our case, we have computed the costs, which are basically associated with what? Associated with those particular different order size. Now, if you check on what the examiner was asking, the examiner was asking about the cost minimizing order size. The cost minimizing order size. Remember, in our case, we have 3 order size. The company can either order 100 mattresses, 120 mattresses, or 180. Which order size will result to the least cost? So the one which will result to the least cost is the third option here. Is the third what? Options here. Is the third what? Option, the third option. And therefore, in this case, we will say what? We will say the cost minimizing order size. Order size is 180 mattresses. 180 mattresses. 180 what? Mattresses. 180 mattresses. 180 mattresses. So in this case, you may also be required to, for example, give an advice to this company. But this was not a requirement of the question. We were just required to ascertain the cost minimizing order size. We have been able to do that, and basically have said that the cost minimizing order size is what? 120. But in this case, you may be required to give an advice to the management of this company. In this case, if we are to advise them, we will advise them to go or to accept a 5% discount. Remember, if the company accepts a 5% discount, or basically we can order them to order 180 units and get a 5% what? Discount, because that is basically resulting to the least what? Cost. So we can say our advice is that to this company is to purchase 180 mattresses, and basically do what? And qualify for what? Qualify for 5% discount. Qualify for 5% what? Discount. Qualify for 5% what? Qualify for 5% discount. Yes. So that is in case you are required to advise this company on what? You are required to advise this company on maybe what to do. Which discount do they need to accept? Which discount do they need to accept? Yes. We are basically done with that one. I want us to look on another one. So these questions are very, very common. You'll be able to see that. You'll be able to see that these are very, very common. Very, very common. Let's look on this other one for September 2021. September 2021. September 2021. 2021, we have question number 3. Question 3. Question number 3B. 3B. So let's go to that question. Question number 3. Question 3B of September 2021. September 2021. If you're there, please confirm. Yes, are you there? Are you there? Are you there? If you're there, please confirm. Please confirm if you have the question with you. September 2021. September 2021 question. Question 3B. Okay, so we are told Fanaka Enterprises uses economic order quantity to establish the reorder quantity of raw materials, raw material Y. The company hold no buffer stock. So in this case, when we talk about buffer stock, this is the safety stock. The safety stock. Safety stock. So we are told the following information related to the raw material Y. We are given the annual usage. Annual usage, remember, we said is also the same with annual consumption. This is actually the same with the annual demand. So basically 48,000 units. The purchase price, which is 80 shillings per unit. The ordering cost, 120 per order. And then the annual holding cost is 10% of the purchase price. You can see the holding cost always is given as a percentage of the purchase price. Of the purchase what? Purchase price. Abdinasil, I've just shared those past papers in the class WhatsApp group. Can you check? I've just shared those papers in the class WhatsApp group. Although maybe someone can take a photo of the question and maybe post it in the group to assist our friend here, Abdinasil. Okay, so we are told the company, in the last paragraph, the company as a supplier of raw material Y has offered a discount of 1% of the purchase price if each order placed is for 2,000 units. For 2,000 units. So what are we required to do? One is we compute EOQ of material Y. Roman 2, we advise the management of this company on whether to accept or decline the discount. To accept or decline what? The discount. We start with Roman 1. Roman 1 is quite simple. That's why you can see only 2 marks are given. 1 mark is given, EOQ, for raw material. For raw material Y. Raw material Y. So this one is equal to the square root of 2D C0 all over HC. And I think in our case, we have these particular values. We have all of them. We take 2. We have the annual demand, or basically the annual usage, which is 48,000 units. That is the annual demand, 48,000 units. Then we multiply that with the ordering cost per order, which is 120. And then we divide that with what? The holding cost. The holding cost in our case, is what? Is 10%. Now, Italy, you have already computed this. You are very fast. Yes. So this is basically 10% of the purchase price. The purchase price is basically 80. Is what? Is 80. So this one will be 10% of the purchase price. The purchase price. Our friend here, Italy, has already computed that. Italy, you are very fast. So maybe just confirm this. Just confirm whether we're going to get those 1,200 units. 1,200 units. 1,200 units. Is that what you're getting? 1,200 units. 2 times 48,000 times 120 divided by 8. Square root answer. Yes, so that basically will give us what? That will give us 1,200 units. 1,200 units. So this is the economic order quantity. Just 1 mark which was allocated for that. So then we go to Roman 2. Roman 2, we are required. What are we told here? We are told to advise the management of this company whether to accept or decline the discount. So we are required to do what? To advise on whether to accept or do what? Decline the discount. Decline what? The discount. Decline the discount. Should the company accept this discount or not? Remember what you're told in the last paragraph. We are told the company supplier of raw material Y has offered a 1% discount if each order placed is for 2,000. Remember, we are saying here, as per what we have computed here, for the company to be able to minimize the cost associated with the raw materials, the company has to be ordering 1,200 units. So this is the order size, which will basically minimize what? Minimize the raw materials costs. But we are told here, the company has been given another option. Instead of ordering 1,200 units, why not order what? Why not order 2,000 units, and then you qualify for 1% discount? So basically here, just like what you have done in the other question, the company has two options. There are two options available to this company. The first option basically is to order 120, or not 120, rather 1,200 units. So if the company order this, the company will pay how much per unit? As per the information we have below paragraph 2, the company will pay 80 shillings per unit. That is the normal purchase price. If the company purchases 1,200 units, and also remember this is the purchase price, which is basically P. So what will change here also is this one. The holding cost per unit will be equal to 10% of this 80. The holding cost will be what? Will be 8 shillings per unit. So if the company order 1,200 units, it will pay 80 shillings per unit. The holding cost will be 8 bob. But now the company has been given option 2. Option 2, instead of ordering this, the company has been given an option to order 2,000 units, and the company qualify for 1% discount. So if the company qualify for 1% discount, the company automatically will not pay 80 shillings per unit purchased, but the company will pay 99%, because it is 1% discount, 99% of the purchase price, which is basically 80. So this will give us what? If the company accepts the discount. If the company accepts the discount, the company here will pay 79.2. 79.2, 99% of that. So I hope you're getting that. Yes, that also means that the purchase, not the purchase, the holding cost per unit will be 10% of this, 79.2. And basically that will give us 7.9 what? 0.92. 0.9 what? 2. Now, what basically we need to do, just like the other question, we need to evaluate those two options. How do we evaluate those two options? We need to compute the total cost of each option. Then we are going to, if for example, this now option 2 will basically will result to a lower cost than option 1, automatically we're going to advise the management to accept the discount. But if option 2 will have a higher cost than option 1, we are going to advise them not to accept the discount. So let's evaluate these two options. We start with the option 1, where our Q is 1,200 units. 1,200 units. And remember, you evaluate this option in terms of computing what? In terms of computing the total cost. So what will be the total cost? Maybe you can first of all have the formula, the purchase cost, which is equal to P times D plus the holding cost, which is equal to what? To Q divided by 2 times what? Times HC plus the ordering cost. The ordering cost, which is basically equal to annual demand divided by Q times what? Times C naught. Times C what? A naught. So let's start by computing the cost of the first option. The first option, where basically our Q is 1,200. So the purchase cost will be equal to the purchase price here, which is 80 shillings, times the annual demand. The annual demand, I hope you can be able to recall that in our question. The annual demand is 48,000 units, plus the holding cost, which is equal to Q. Our Q is here is 1,200 divided by 2 times HC. HC is 8 shillings here, plus the ordering cost, which is equal to annual demand, 48,000 divided by Q, which is 1,200 times what? Times ordering cost. The ordering cost in our case is how much? The ordering cost is 120. 120. So we get the total cost of that. Let's get the total cost associated with that order size. The total cost associated with that order size. What will be the total cost associated with that order size? What are you getting here? I'm getting what? 3849. I'm getting a different figure. Naitari, is that correct? I'm getting this one. 38 49 600. 600. That is what, yes, that is also the same figure I'm given by this there. Yes, Naitari, confirm your answer. I don't think it is correct. I don't think it is correct. And also, I hope you can see that because these are economic order quantity, you can see that these two costs are the same. That's what you have said. At E or Q, always those two costs must be the same. So then I want us to evaluate the second option, where our Q is basically 2,000 units. 2,000 units. So what would be the total cost associated with this? So we start with the purchase cost, which is equal to the purchase price. The purchase price per unit is 79.2 times the annual demand or the annual usage, which is 4,800, plus the holding cost Q, which is basically 2,000, divided by 2 times HC. HC here is 7.92, and then plus the ordering cost. Ordering cost is equal to annual demand, 48,000, divided by Q, which is basically 2,000. 2,000 times what? Times 120. Times 120. Times 120. Times 120. Yes, so let's work out this. Yes, what are you getting? I'm getting 3812 400. 3812 400. 3812 400. Yes, 3812 400. 3812 400. 3812 400. 3812 400. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. Yes. Now, in this case, what we need to do is basically we now move and basically we advise the management of this company. Should they accept the discount or not? Should the company accept the discount? Remember, if the company is to accept the discount, the company will have to order 2,000 units. So what you need to do, you need to compare the cost of the two order size. Remember, the order size here is 1,200 units. The order size here is 2,000 units. So should the company accept the discount or not? Should the company accept the discount or not? Should the discount be accepted or not? Yes, automatically the discount should be accepted because you can see that there will be some cost savings. There will be some cost what? Savings. Or in other terms, we can say that the company will incur the least what? Cost. So we say, we give the advice. Advice will be accept the discount. Accept the discount. The discount since it results to cost what? To cost savings. To cost savings. Remember, currently, the company is ordering 1,200 units. So how much cost is incurred by the company currently? The company is incurring this cost. This is the cost incurred by the company currently. But if the company accepts the discount, we say there'll be some cost savings. The cost savings is the difference between those two costs. The cost savings is the difference between those two what? Costs. Can you tell me how much is the difference between the two costs? Between the difference between the cost of the two options. The difference is 37,200. So since it will result to cost savings of shillings worth 37,200, basically which you're saying is the difference between 49,600 and 38,12 forward 400. So that will result to some cost savings. It will result to some cost what? To some cost savings. It will result to some cost what? Savings. Sawa sawa? Yes, yes. So maybe what I want us to do, we take a short break. And then once we come back, I want us to look on something called the multiple quantity discount. The multiple quantity discount. Because basically what you have dealt with here, this one is basically called a single quantity discount. A single quantity discount. So if the company purchases, for example, 2,000 units, the company qualify for what? Like 1% discount. That is a single quantity discount. But we have another option whereby the company will be given a multiple quantity discount. I'll be able to explain what you mean by multiple quantity discount. How do we evaluate now such option, and basically how do we advise the company? Sasa, yes, but I want us we have that discussion once we come back after a short break of just 10 minutes. So after 10 minutes, we come back, we continue with that. Yes, so I want us to continue. I hope you're back. Are you back? Are you back? Are you back? Aaron, are you back? Zipporah, are you back? Naitari, are you back? Emma, are you back? If you're back, please confirm. Please confirm. Please confirm. I want us to look on this. That is basically the multiple quantity discount. Multiple quantity discount. Now, when we talk about the multiple quantity discount, this whereby discounts will basically be given for different quantity rates. For different quantity rates. And actually, the main objective of this multiple quantity discount is usually to encourage buyers to buy more quantity at lower prices. More quantity at lower prices. The more the quantity you purchase, the higher the discount you get. The higher the discount you get. And therefore, when we talk about a multiple quantity discount, this whereby, for example, you have a supplier, assuming you have a company and you buy some raw materials from your supplier, and you're told, if you buy between, for example, maybe 0 units, or basically 1 unit, that is, 1 unit, maybe to like 99 units, maybe in this case, there will be no discount here. Or maybe the discount here will be 0%, no discount. But if you buy now from 100, for example, to 199 units, you will qualify for something like 2% discount. If you buy between 200 to 2, or maybe to something like 499, maybe you will qualify for 3% what? Discount. If you buy between 500 and above, 500 and above, maybe you qualify for what? For 5% discount. Now, this one is called a multiple quantity discount. You can see the main objective of this discount is basically to encourage buyers to buy more quantity. The higher the quantity you purchase, the higher what? And the discount. The higher what? The discount. Now, in this case, automatically what we need to do here is to advise the company the quantity range to pick. Should the company order this the quantity range? Should the company order units which lies within this quantity range? Should the company order a unit which lies between this quantity range and so on? So that basically is the main objective here, to evaluate basically each quantity range and basically go ahead and you give an advice to the company. Should the company or which order range should be picked by our company? Automatically, the order range to be picked by our company is the one which result to the least what? Cost. And actually, we also evaluate this particular order or this quantity range by computing the cost of each quantity quantity range. And therefore, in case you come across such a question whereby we have multiple quantity discount, the first thing you need to do is to purchase, that is to compute, that is, you need to compute the purchase price per unit. Remember, the purchase price per unit is basically a P, because, for example, here you can be told between 100 and maybe 99, the price is maybe 10 shillings. So what will be the price here? The price here automatically, because the company will get a 2% discount, the price here will be 98% of over 10 shillings.
Good evening, T. Good evening, VMM. And good evening, Walter. Can you hear me? You respond with a yes if you can hear me. Perfect. So we talked about what we call taxation across the borders. And the last statement that we basically made, we talked about individuals that are basically affected by what we call double taxation. One of it, we say that these are citizens that basically work abroad, or one of the few people that are affected by double taxation, citizens working abroad. We have what we call the expatriate employees working in Kenya. We have sportsmen or professionals, sportsmen and entertainers that basically earn income from abroad. Then we have businesses that are carried partly in Kenya and partly outside Kenya. So then we get to what we call the objectives of double taxation agreements. What we call the objectives of what we call double taxation agreements. Objectives of what we call the double taxation agreements. So what we call the objectives of what we call the double taxation agreement. So what do you think are the objectives of what we call double taxation agreements, where two countries engage into an agreement for citizens probably working in those two particular countries? One of which is basically to attract investment. We say to attract investment. So basically, when you're taxed on both ends, will that be able to attract investment? Let's say, for example, there is the two countries, for example, Kenya and let's say China, and we do not have double taxation agreements. What happens? It basically implies that you're going to be taxed double. And in that scenario, do you think we'll be able to attract what we call investment? We will not be able to attract investment. So we say to attract what we call skilled manpower, to attract what we call skilled manpower, to basically attract what we call the skilled manpower as a second, to attract what we call the skilled manpower, then to protect citizens of the country, protect what we call citizens, we say of a country, we say from what we call from double taxation, to basically protect citizens of the country from what we call the double taxation, to protect what we call the citizens of the country, we say from double taxation. We can also say to facilitate, we say to facilitate what we call free movement, we say of labor, to facilitate what we call free movement of labor. In instances where an individual is taxed double, in cases where countries do not have what we call the double taxation agreement, people will not easily move altogether. Then say encourage citizens of the country, encourage what we call citizens, say of a country to look for jobs, for jobs abroad. So this definitely will encourage what they call the citizens of a country to basically look for jobs abroad because of these agreements. Together, team. If you're together, then you just give it a yes. If we are together, then we give it a yes. So what are some of the countries, VMM, switch off the video. What are the countries, some of the countries that Kenya basically have what we call a double taxation agreement with? What are some of the countries that Kenya basically have what we call the double taxation agreement? What are some of the countries that basically Kenya has what we call a double taxation agreement? For sure, United Kingdom, Kenya has what's called a double taxation agreement. We have India. We have what we call the East African Community, that is Uganda, Tanzania, Burundi, and Southern Sudan. We also have Sweden. These are some of the countries that basically Kenya has what we call a double taxation agreement. And the essence of those agreements, we've talked about the objectives of those agreements on this particular. So I want to talk about what we call conditions to be met. Conditions to be met. We say to be met. We say in order to qualify, in order to basically qualify for what we call for double taxation relief. So we have what we call conditions to be met in order to qualify for what we call the double taxation relief. Then in order to qualify for double taxation relief, there are certain conditions that must basically be the certain conditions that we understand that must basically be met in order to qualify. What are these conditions that basically must be met in order to qualify for what we call double taxation relief? What are these conditions that must be met? So in order to qualify, tax must have been paid in other countries. If you're Kenyan, the tax must have been paid in other countries. So the first one, we say the tax must have, we say, been paid. The tax must have been paid in that, we call it other country. The tax must have been paid in that other country. On income, we say subjected to what we call to double taxation. On that income that are basically subjected to double taxation, that the tax must have been paid to that other country, basically on that income that we understand is subjected to double taxation. Number two condition will basically say that double taxation relief, double taxation relief, we say should not exceed. So what you call the double taxation relief should not exceed what you call the tax payable in what call in the home country. But the double taxation relief should not exceed tax paid in the home country on income subjected to double taxation, on the income that we understand is subjected to double taxation. In most of the questions, you'll always find that the tax on other countries is lower, are we together, as compared to the same income subjected to, as compared to the same income subjected to taxation in Kenya. Together, team, we respond with a yes, if you're together. Are we together? So the third, there must be what you call the double taxation relief policy. There must be double taxation. There must be what you call the double taxation relief policies, say in the country. There must be what you call double taxation relief policy in the country. There must be what you call the double taxation relief policy, and we understand in the country. Then we say we have four that we call time limit. Number four, we understand the time limit of making the claim of making what's called the claim. Of making claim, we say for a relief, time limit for making claim of relief is usually we understand 6 years since the tax payable, was paid in what's called, was payable in that other country, was payable in that other country in relation to income, in relation was 6 years since the tax payable was paid in other country, in relation, we say in relation to double taxation, in relation to what we call double taxation, in relation to what's called the double taxation. Those are conditions in order for one to qualify for what we call the double taxation relief. We respond with a yes. Together. We'll respond with a yes if you're together. All those conditions. We give it a yes if we are together. 𝐎𝐿𝐶𝐒, are we together? I'll say it on those conditions in order for one to qualify for double taxation relief. The tax must have been paid in that other country on income subjected to double taxation. There must be double taxation relief policy. And we basically said that the double taxation should not exceed the tax payable in the home country subjected to what we call the double taxation. So we get to what we call areas covered by double taxation agreement. Areas, we say covered by what we call double taxation, areas that are basically covered by the double taxation agreements. Areas that we understand are basically covered by the double taxation agreement. And so one of the areas we basically say persons covered by the agreement. We understand the next is taxes covered by the agreement. Incomes that are affected by what we call the agreement. We have what we call terminations of agreement. Are we together? Terminations of agreement. So we can, what we call, one is persons covered by agreements. Persons that we know are covered by agreements. Number two, taxes. We understand covered by what we call agreements. Taxes are basically covered by agreement. Then number three, we have what we call incomes. Incomes, we understand affected by what we call the agreements. Incomes that we understand are affected by the agreement. You also have another area what's called terminations. Terminations of what we call agreements. Terminations of agreements. So then we have aspects of determination of residence of a taxpayer. Aspects of determining what we call residency of a taxpayer. Together, we respond with a yes, basically on areas that are basically covered by double taxation. Together, team. FJ, Lenovo, Mary, and the rest of the class. Tuko pamoja. If you're together, then we respond with a yes. So then if you're together, then give me a yes. So then we go to forms of double taxation relief agreements. What we call forms. Forms of what we call double taxation agreements. Forms of what we call the double taxation agreements. What we call the forms of double taxation agreement. One of the first form, we have it as unilateral. We have the first form, what we call unilateral relief. So when you say unilateral relief, what do you basically mean? Unilateral, before we get to bilateral, what do you basically mean by unilateral relief? Unilateral relief. I hope Miriam is in class. I hope Miriam is in class. And I hope Chengo is also in class. Perfect. And I hope Chengo is also in class. Yes, perfect. And I hope Gilbert is also in class. I hope Elvis is also in class. I hope Elvis is also in class. Perfect. Our representative, Sheila, I hope she's also in. So when you talk about unilateral relief, what do you basically mean by unilateral relief? Unilateral relief. When you say unilateral relief, we say this is where we say that the government, this is where the government, we say that this is where the government decide to grant, decide to grant what they call relief, decide to basically grant relief to its citizens, working abroad, decides to grant relief to its citizens working abroad who are subjected, we say who are subjected to what we call double taxation, who are basically subjected to what's called double taxation, without considering. Unilateral touches on one aspect. We say without considering. We understand that without considering whether other governments grant what they call their citizens, working in the country, double tax relief. And that is simple. What are we trying to say? That when you talk about unilateral, you basically grant to your citizens working abroad, you grant them relief without considering that the expatriates are granted relief by their countries altogether. That is basically what's called unilateral relief. Together, we respond with a yes. We respond with a yes if you're together. So then we go to bilateral. What they call the bilateral reliefs. So what is bilateral relief? What they call the bilateral relief. So what is the bilateral relief? What is a bilateral relief? When you say bilateral relief, what do you basically mean by the word bilateral relief? Somebody is trying. If we understand this, then this should be simple. So who can give us this? If you understand the unilateral, then bilateral should be very simple. So what is bilateral? So bilateral, countries basically considered. Bi means two, not more. Bi basically means two countries. Mary, when you talk about bi, basically means two countries. Are we together? They are in agreement. Not only one country is in agreement, to grant its citizens, both parties are basically involved. And that is to say, we say this is where, we say this is where, this is where, this is where, we say two, this is where two or more countries, but specifically by should be two or more countries negotiate, and say conclude, negotiate and conclude what they call the double tax relief, negotiates and conclude what's called the double tax relief, the double tax relief agreement, double tax relief agreements to say where the citizens, where we say the citizens, where the citizens working in these countries, working in these countries are granted what we call the double taxation relief, where citizens working in these countries are basically granted relief. So they say, basically say, even when you say more countries, so more countries could have Kenya, we could have Kenya and maybe China, we can have Uganda and Kenya, but they're coming in agreement together, where those personnel from the country working in both countries are basically granted what they call the double taxation relief. On the unilateral, what we say that if we are talking about unilateral, we grant this relief to personnel, basically Kenyans working abroad, but you don't consider whether those other countries are providing relief to their people together. So we go to the methods of determining double taxation relief. So we go to the methods, we call it methods of what we call of determining what we call the double taxation relief. So methods of determining what we call the double taxation relief. What are the methods that we basically have to determine what we call the double taxation relief? So there are basically two methods. We have the exemptions method, and then we have what we call the credit method. So we have number one, we call it exemption. We call it the exemption method. And number two, we call it the credit. We call it the credit method. So we have what we call the exemption method, and then we have what we call the credit method. So we have what we call the exemption method, and we basically have what we call the exemption method. We have what we call the credit method, and then we have what we call the exemption method. I want to start with the exemption method. To exempt, what does it mean to exempt? To exempt, what is exemption? When you say to exempt, not charge tax, perfect, Mary. So we have the first method, and we're calling it exemption. We are calling it the exemption method. We are basically calling it the exemption method. So the first method, we call it the exemption method. So we're saying in this, we say income. In this, we basically say that the income, and this the income, in this the income, say and abroad, and we say affected, and affected by what is called by the double taxation by the double taxation and affected by what they call the double taxation, we say is not subjected to what they call tax. So basically, we're saying that the income that is earned abroad and affected by what they call the double taxation, the country will not basically now subject it to tax in the home country, to tax in what they call the home country. Will not subject it to tax in the home country, as long as, we say, as long as the tax was paid in what you call in the source, as long as the tax was paid in the source country, as long as the tax was paid in the source country, as long as the tax was paid. So say the country, source country is country where the income we say was generated. So source country is the country where the income was basically generated. The source country is basically the country where the income was generated, where the income was basically generated together, where the income was generated. All of us are together. I want to pose a question. If you're together. Perfect, if you're there. So the question is altogether. I believe there's much closure in terms of now you understand what happens altogether. What happens if you have maybe family members abroad altogether? When you have family members abroad, are we together? When you have what you call a family members abroad, are we together? I'm moving. When you have what you call family members abroad, are we together? And the questions pertaining to what you call tax, how do you go about it together? In cases where there have been, how would you go about it practically? In case, for example, we have what you call an exemption clause altogether, but they have a PIN. What are you going to do? When you look at two countries, you have what you call an exemption clause. What are you going to do in scenarios where we have what you call an exemption clause? But they still have a PIN. So that PIN, what are you going to file on that PIN? On that PIN, there's not an income that was generated in Kenya. The whole of their income was basically generated abroad, but we have in scenarios where we have exemption clause. With that PIN, what are you supposed to do with that PIN in terms of now filing taxes? So what are you going to do to that PIN? That is the question. What are you going to do to that PIN? We respond with a yes. What are you basically going to do with that PIN? Kindly, what are we going to do with that PIN? So basically, it's say exemptions altogether. Exemption is basically exemption. You ask for a refund. You ask for a refund. Why should you be refunded? And we have what we call exemption clause. I want to expound on the exemption clause. We are basically saying that as long as you are paid, you are a citizen. Yes. Yes, perfect. With supporting exemption certificates altogether, with supporting exemption certificates altogether. In that case, what are you going to file? What are you going to file? I know practically there are a few areas of application and a number of things. Practically, not many people make this disclosure. Is that true? Practically, not many people make this disclosure. Is it true? When it gets to this area, how do you find, for example, for those brothers who are not here? Yes, they definitely file nil altogether. But again, you need to provide maybe along the way, you need to provide those supporting documents altogether, especially when we have what we call exemptions altogether. Those supporting documents implying that there is what we call exemptions between those two countries. Then you have what you call the credit method. The credit method, we have what you call the credit method. So on the credit method, this is where majority of the questions basically come. When you have the credit method, this is where majority of the question come. So we say in this case, we say that the tax paid, basically in this case, the tax paid in that other country, the tax that is basically paid in that other country. So what we call the source country, stroke the source country, on income, subjected, on income, we understand subjected to double taxation, on income that is basically subjected to double taxation, on income that we understand is subjected to double taxation, is granted, we say is granted as relief in relation to tax payable, on relation to tax payable in what call in the home country. We say on income subject to what we call double taxation. Taxation. So I just want to remind us on something. We say conditions that have to be met. What did I say about condition 2? Conditions that must be met in order to be granted what we call the double taxation. In order to be granted what we call double taxation. I think it was condition 2. That was condition 2. What did I say on that condition 2? That the tax that you're basically paying abroad should be less than the tax that you're paying in the home country, 𝐻𝐿. So that tax that you're paying in the source country, you are basically granted. It is always what you call the lower. It is always what you call the lower to get a team. That's why you say that the tax that you basically paid abroad will be granted as what you call relief. It will be granted as a tax credit. We'll respond with a yes if it's together. Will be granted as a relief. Basically, with our condition number 2. Basically, condition number 2. We'll respond with a yes if it's here. Subject to condition 2. Perfect. So I want to ask to determination. Now then we get to question, determination. Determination. We'll call it determination. Determination of tax. Determination. What we call determination of what we call tax of double tax. What we call the double tax relief. Determination of what we call the double tax relief in Kenya. Determination of what we call the double tax relief in Kenya. And what we call determination of what we call actual tax, of what we call actual tax payable, and what we call the actual tax payable by what we call persons, we say affected by persons that we say are affected by what we call by double taxation. by double taxation. By double taxation. We understand those persons that are affected. Are we together? Do we understand on those persons that are basically affected by what we call the double taxation? Persons that we say are affected by what we call the double taxation. We know the persons that are affected by the double taxation together. Is there a question on those who are affected by double taxation? Or that was exhausted perfectly well? Was that exhausted perfectly well? On persons that we understand are affected by what's called the double taxation. Perfect. So how do we determine, based now on the credit method, double taxation relief and the actual tax payable on the persons that are affected by what we call the double taxation relief? Number one, the double taxation relief is comparison now together. The tax that was basically paid on the source country, that is basically income that was earned abroad. Then you put that income in terms of the Kenyan system and you get the tax that is payable. Are we together? You get the tax that is payable. Remember, under the intermediate, we basically say that for resident, their employment or for business that are partly operated in Kenya and partly operated outside Kenya, we say that both incomes are basically taxed in Kenya. And the big question is that, is this now double taxation? And how do we sort those issues? Does this basically provide solution to those issues that we talked about on intermediate? Does it provide solution? If you remember, for those that I taught on the intermediate, does this provide solutions to those? Does that provide solution to that? Because the question is, if you say that you'll be taxed here and taxed that on the other side, what if you're taxed on the other side? How do we go about it? Are we together? But first of that determination of the of double taxation relief, we understand that the double taxation relief is basically the tax that was paid on the source country. That is the tax that is paid in abroad, which in our case, we understand that if you subject that income that was earned abroad in terms of taxation in Kenya, the tax that is paid in Kenya should be higher. Are we together? Because the tax that was paid outside the country should be lower on the condition. Then how now do we determine the tax payable for these persons that are affected by the double taxation relief? So we understand that the double taxation relief, once we get it, we compare the tax that was basically paid abroad and the tax that was paid in Kenya. And we understand that the tax that is basically paid abroad is lower. We are going to use that tax that was paid abroad as what we call the tax credits. Together, team, we are going to use it as the tax credit. You give me a yes if we are together. You give me a yes if we are together. You give me a yes if we are together. And we basically said on these classes that the most important thing is to understand the concept. It's not a question. The most important thing is the concept behind what you're about to do. Are we together? So once we get the concept is the most important thing that we need to focus on. Once we get the concept right, we don't have to be perfect. We can go step by step. You can miss one step altogether. Prayer break. Can we take it now, or we give Aziz, you can allow us to finish this? Or class, are we in agreement that we take a break? Are we in agreement that all of us will take a break? Can we? So Aziz, you okay? You'll get us back. We also don't want to leave Aziz. So what we do, we grant the break to, we respect it's time for prayer, and then we come back. So we give our 10 minutes. When you come by 7:01, yes, it's okay. Ouko, you're making the class lively. It's okay. So we can take our break so that we also respect it's time for prayer. The double tax relief is basically the law. One is tax payable. We call it tax payable. we say in Kenya, tax payable in Kenya on income, we say subject on incomes that we basically say subject to double, subject to what they call double taxation on incomes that we understand are basically subject to what they call the double taxation on incomes that we say are subject to double taxation. So you compare with the tax on what they call on the source country, tax on basically what you call the source country. We say on income, we say subject to what we call double taxation on income that we understand are subject to what we call double taxation together. So which on the condition, we basically know that the relief will be the tax that is from the source. So we say the steps in determining, we say in determining what we call the double taxation, steps in determining what we call the double taxation relief, and what we say and what we call the actual tax payable. So the steps that we use to determine the double taxation relief and actual tax payable by the taxpayer. And the actual tax, we say payable by the taxpayer. And the actual tax that we understand is payable. So I want us to be very keen on those steps, I want us to be very keen on these steps. I want us to be very keen on these steps. So look at those steps. I want us to try and finish those steps in the next 10 minutes, we finish those steps. So the first step, number one step, we say that determine the taxable employment. Determine what we call the taxable employment. Income, we say earned in Kenya. That is number one, determine what we call the taxable employment income earned in Kenya. So number two, we say determine what we call total tax payable, on income and in Kenya. So when you say the total tax payable, what do you basically mean? When you say the total tax payable, what do you basically mean? That is employment plus investment income. That is what you call the employment plus what you call the investment income. So we have the employment plus what you call the investment income, employment plus what you call the investment income. Together, team. Employment plus the investment income. So then with determination of tax payable, number three, we call it determination of what we call tax payable to income of tax payable of income, we say earned in Kenya, and what we call the outside Kenya. So determination of tax payable of income, this one was basically in Kenya. But point three, we also include what we call the income earned outside Kenya. Together, team. Income that is earned outside Kenya. We'll respond with a yes if you're together. So income that is earned in Kenya plus income that is basically earned outside Kenya. Together. Income that we know is earned in Kenya and income that is earned outside Kenya. All of us tuko pamoja. So number one was employment income. Number two, you include employment plus investment. Then number three, we also include now the income that is earned outside Kenya. Together, Robert, Norbert, and Gilbert Mitich. Together, if you're together, we respond with a yes. So we have this was taxable income, so taxable income. This was determination of taxable income earned in Kenya and income earned in Kenya and outside Kenya. Number two, determination of tax payable on income earned in Kenya and outside Kenya. Then number four, we say that determination of total tax, we say determination of what we call of total tax on what we call on total income, total tax on what we call total income, and in Kenya, and in Kenya, and in Kenya. So this is the taxable income, but now you determine the tax altogether. This is the taxable income. Remember, this is taxable. That's why I changed taxable income. After taxable income, you determine what you call the total tax on income earned in Kenya, and what you call outside Kenya, on income earned in Kenya, and that is earned outside Kenya. So say that is determination of total tax on total income. Determination of what we call total tax, we'll say on total tax, on what we call on total income. So after determining what we call the taxable income, that is both in Kenya and outside Kenya, so you determine the tax that is payable on the total income. Then five, determination, we get determination, we say determination of tax income, and in Kenya. Determination of what we call the tax income and in Kenya. So I want to ask a question. The difference between this and this, what does it give us? The difference between number 4 and 5, what does it give us? The difference between 4 and 5, what does it give us? The difference between 4 and 5, what does it give us? So 4, we basically say that is the tax payable for income that is basically paid for income earned in Kenya. Yes, it's a tax on income abroad altogether, or the relief altogether. So that is the tax that is charged on abroad, which is the relief. That is the tax that is charged abroad, or what you call the relief altogether. So that determination. Then 6, we say this. We say it determination. We say determination of tax. We say on income. Determination of what's called tax on income. And outside Kenya.